we have to talk about something. We have to talk about the cable to start with. Did you see what happened?
Crazy. Nuts.
Went nuts. An algorithm went completely doolally. So this is the chart. So we're going to flick in and out of charts quite a lot today. So for those guys that are kind of watching, the only thing you're going to miss is the fact that I haven't brushed my hair. So this was it. This was the cable. And that's just a 5-minute chart, and that's not actually even the registered low. My chart gets us a registered low down at sort of about 120.34. The actual official registered low was 118. They did post a 114, but the official low is 118. I think 114 was it made it a bit more glamorous. It never actually traded down there, so the exchanges have said about 118.19. I say about, they said exactly 118.19. Nobody really knows the reason why. Bearing in mind it happened at midnight, you kind of think it's just an algorithm gone nuts on a day change, really, or a clock change, or something's happened and it's just triggered us massively lower, which is quite unbelievable, really. It's a big shock of a move. So it is what they would call a flash crash. They're happening quite a lot at the moment. The number of trades going into it, if you look at the sort of top corner, we had 11 there, 2 there, 3 there, 200 went through there, which is interesting. Then we dropped down to 35.50, and then on this bar 2,500 trades, and on that bar 1,400 trades before it sort of started calming down. So yeah, pretty nutty stuff. But of course, what's the two things that strike me? Firstly, we haven't recovered. Although we're back at 124, you can see the actual initial drop was from up here at about 126.50. So we haven't actually recovered the full extent of the move, which means although it was a flash crash, and although it was sort of an unprecedented non-fundamental moves, prices have been accepted a lot lower at 124. So of course there is a knock-on effect here, and the knock-on effect is quite simply that the FTSE is doing very well today. So exporters and companies doing business abroad, as we've discussed, this is obviously good for them. So in terms of the two ways to look at it, if you are now a British business company doing business abroad, instead of if you were selling something for $1, instead of getting back the equivalent of 60p, you're obviously now edging ever closer to getting a full $1 back. So therefore profits rise, and those companies are doing very well out of it today. Of course, the other side of the coin is that this is inflationary. So of course, the weaker our cable gets, the cheaper it is for other parties, other people to either come here in terms of tourism or to purchase goods over here. It's actually now becoming cheaper for them, therefore driving prices higher for the increased demand. So there is a whole knock-on effect, and this is sort of where we left off sort of Wednesday, understanding how all of these markets are correlated. So of course across the board, although we've got this cable who has done that, the contagion effect in the euro, so of course our sort of closest trading partner, we've got a bit of contagion effect here. So you can see the euro absolutely fell out of bed as well yesterday. and has continued that move down. And of course the Bund and the gilts as well, bearing in mind this is an inflationary environment. Of course the Bund has suffered as well, so off the bat today the Bund has dropped lower as that has fed through. In terms of our stocks as well, we did have an initial rout to the downside, but we have recovered that and have started creeping further back up the page, and the S&P has recovered from sort of a lackluster day yesterday and has sort of priced itself a bit higher. So it's very, very interesting bit of news, really. I mean, it's whether they look into it and whether they decide that there's anything to do or whether it's just a fault of a computer. I suspect they will tell us who it was. I think the worst thing about it that I've read is the amount of people that have lost a significant amount of money, because there were people attempting to find a low in the cable. And actually, if you look at one of the candlesticks, I think this is where people got very, very trapped. This is a daily chart. So we've had this sort of big hemorrhage down. We've had 2 big down days. This is actually this green candle in here, which will sort of come across that setup as we sort of delve into candlesticks. That's actually quite a bullish signal. So of course it trapped quite a few people into trying to punt on picking a low. And if you listen to any of the streams I did, we spoke about that. We did speak about this being a mildly bullish signal, but the dangers of sort of flying in the face of such fundamental news. But I do think people probably attempted that trade, and there's a few people that have, sort of young kids, young traders who have been on Twitter and said, I've done 15, 20 grand, that's me done, finished, out of the business, because obviously they're not quite understanding the relative risk reward, and of course as all the spread betting firms tell you, losses can exceed your deposits and they don't guarantee stops. So of course there is a fair old amount of slippage. So I think IG reported their opening call was at about 112, and of course there were reports of about 114, which you picked up on. So of course all of these traders can get filled down there, when they think they've got a stop, a non-guaranteed stop, especially through spread betting accounts. So it's done a lot of harm across the board. So it is particularly dangerous, sort of seeing these types of moves, and that's the danger of having 24-hour trading that is completely unsupervised by a human being. It's just a pure algorithm and a robot that sat in there. I haven't heard anyone say, I just so happened to be at my desk at midnight and cleaned up. Funny enough, there's no stories like that. Yeah, massive bit of news, really, an interesting bit of market dynamics. So yeah, that's kind of where we lie. We kind of got here quite quickly. Everybody's now sort of talking about a tightening policy, and you're getting, this is just another sort of leg in what we're seeing, really, because it's had such a big move and it is so inflationary. That you could actually see the Bank of England attempt now to stave off some of the inflation, by maybe tinkering with rates or tapering or some of these other things that we're seeing out of the ECB. And if you get a particularly strong non-farm payrolls today, I think you could very, very easily see some big moves across the bond markets as we sort of adjust and we'll head towards tapering.
I still think the economy is too fragile for them to start tinkering. We've got to give it a bit of time to see how this filters through.
Yeah, I don't disagree, but I do think the economy is still too fragile. But you do wonder whether there's a lot of rhetoric quite quickly in terms of this sort of policy. You know, we've gone instantly from the Fed are never going to raise rates, Draghi's an uber dove, and we've just done more QE and lowered interest rates in the UK, and we've all of a sudden turned around and are talking about ECB rumours of tapering, inflation now likely to be a concern in the UK, and a strong non-farm payrolls could just give us, it could be the lift-off for the Fed. What sort of harm it does, or whether we can deal with it, I don't know. Non-farms will be interesting today, you know, especially, you know, depending on how we get through stuff. You know, we could put the ladders up and watch it, but you know, a strong non-farm payrolls, you could easily see people start pricing in the Fed raising rates in December. And of course, I do think that we're in such, because of where we've moved, and because, you know, if you look at the Bund, this is how we've moved very, very quickly, sort of down from our all-time highs. We're sort of 3 points, 2.5, 3 points lower. So we're at a pinch point in the Bund that could accelerate, and the 10-year specifically. I mean, we spoke about it yesterday, but the way in which the 10 years come off has been even more aggressive. You know, we've done it. We've not even got overlapping value areas. We've just got pure. This is pure price facilitation and pure price moves. Which, you know, funny enough, this is one of the charts we'll go through a bit later today. But they're not even got overlapping values. You know, we are just, the market's doing a very good job of facilitating trade lower, and that's when you look at the markets. Its primary objective is to facilitate trade. And if you look at it and you think, is this market still doing a good job of facilitating trade lower? The answer is yes. You know, so that indicates that prices can still go lower. Yesterday was the first day that we had a slightly overlapping value, where we've just sort of crept into it a little bit and actually explored the full extent of value. So it does show a bit of a cooling. All things being equal, it does show that this is cooling a bit, as it's got to that sort of 2 standard deviations away on this Bollinger. It shows that it's cooling down a bit. But I do think a strong non-farms could actually just shove it over the edge and just push it that little bit further. So yeah, it's certainly been an interesting overnight, and it is an interesting environment that we've crept into, because all of a sudden, you know, we have adjusted from you know, the all-time highs to, you know, and very low interest rates that we assumed were going to be around forever, to an environment where we're starting to and ah about tapering or rate hikes, or just a tightening policy, a move from accommodative to tightening, is really what we're looking at. So yeah, interesting start. Has anyone got any questions on what we've seen overnight, or oh, hang on a sec, is this from today? Oh, I think they're talking to each other. Oh, they're all having a chat between themselves. Good. Oh, that's good. Okay, so no questions on what we've seen, no?
No.
Okay, great. Well, the purpose of today is to really delve into our market profile. I don't know how far you've managed to get through the book. Obviously, a lot of what, you know, this isn't my, make no mistake, this isn't my material. You know, I didn't invent market profile, I just know how to use it. The material was sort of invented by Steedlemeyer, particularly Dalton has kind of taken it over as I guess, explaining it very well, adapting a couple of bits and pieces. So the information that we're going to go through is certainly not my material. It's just that we've got real life charts, and hopefully we can actually explain it maybe a little bit better than if you were reading it through the book. But really and truthfully, we have got quite a lot to go through. So where we left it off, where we were talking last time, was very much almost the very introductory bits, kind of the novice section. By the end of today, I'm hoping that I'd have pulled out and pinpointed the bits that I think are highly relevant from pretty much all the way from advanced beginner through to competent. So I'm hoping to sort of get you up to the point where you're feeling certainly more competent in your viewing of it. But it is, primarily this is information. It's just me being able to maybe put it across a little bit different. So TPO counts, that's where we're going to start. We're going to talk about TPO counts. TPO, if you remember, was the acronym, if that's the right word, that we give to time, price, opportunities. So the letters, basically. So the TPO count is very much the letters that we're focusing on here before we start pushing into the volume. And monitoring the TPO counts help us to evaluate other time frames in control in the developing value area. The TPO count measures the imbalance between the other time frame participants and the day time frame participants. So when it talks about other time frame and day time frame, the difference that we're talking about is we are on the day time frame. The chances are, at any given time, bar maybe about an hour of the day, most of us are going to be flat. We're going to nick in and out. We're going to buy it, look to take 5 ticks, flatten our book, make our money, and then wait for the next opportunity. That's a day time frame participant, someone who's got a very low interaction period. Another time frame participant could be anything from a swing trader who's looking to hold it for the full day, or someone who's looking to hold it overnight and onwards. Just a long time frame participant. So that's the difference that we're talking about here. The day time frame is the yous and me's who are more often than not going to be flat, hopefully with a positive P&L. The TPO count is found by isolating the point of control. That's the TPO point of control, not the volume point of control. Summing up all the letters, the TPOs above it, and comparing it to the number of TPOs below it. The total TPO figure above the point of control represents time frame traders willing to sell and stay short above value, whilst the TPO below represents traders who are willing to buy and stay long below value. The ratio that we get is an estimate for the imbalance that's in the market. So for example, a TPO count below the point of control and growing larger indicates that although price is spending time below the point of control, price is not going anywhere. Had sellers been aggressive, price would have shifted lower. So although we're spending time under our point of control, we're starting to monitor the level of aggression, because had the sellers been aggressive, they'd have trapped an awful lot of longs and the price would have shifted. So actually what we've really got is people that are net long and are happy to stay long. So let's, for the first time, and we're going to do this an awful lot today, flick onto our charts and have a look at what it really means. So for example, this is how we would find it. it's in this little window here. Most of these have this. And so our total TPO count on this day, if we look, okay, so if we look in this box here, we've got this area here where it says total TPO count. We get our TPO point of control in here, and then this is what we're looking at now, the TPOs above and below the point of control. So on this day here, our total TPO count was at the point of time 429, and over the course of the day the TPO count ended up being down here. So the TPO point of control was at 164.18. Now it wouldn't have always been there, because as the day developed, of course, it looks as if it might have been a lot higher, potentially up at this point here. At some point the TPO would have been there, but at the end of the day the TPO count was down here, and the TPOs above were 338 to 79. So quite a large imbalance there, quite an aggressive imbalance, where the number of people that were short in the market and were willing to stay short above that point of control was quite severe. So we can get our first reading on tomorrow from where yesterday left off. So we can get our first reading. We come in, the market hasn't even opened. What do we know coming into today? We know that yesterday left us off where we shifted our point of control a lot lower, and that the amount of people short was quite aggressive, quite imbalanced. So we can just bear that in mind. There's no trading decision to yet be made, because of course we don't know whether they're going to stay in control, or we don't know whether they're going to get squeezed out by aggressive buyers. But we take the information that we've got, and so we know that there was a large imbalance yesterday. So coming to today, what is this telling us? Well, so far our total TPO count is 124, of course, because we're developing throughout the day. Our TPO point of control is at 163.96. So it's at that, the TPO point of control is actually pretty much where VPOC was, that naked VPOC was. And our count so far is telling us that the TPOs above are 69 and the TPOs below are 51. And we can also see that right now price is shifting lower. This tells us that the sellers are still in control. And this is where we can start to make a trading decision, because we can start to see that imbalance and how it develops. So we can see, as today is growing and developing, we can see that the sellers are in control and price is moving lower. So we can sense the imbalance, and we can also sense the aggression in terms of how the price is moving. So at the moment we have more information. We have information that this is a market that you want to align yourself with. The sellers are in control, price is moving lower. And we can then start to align ourselves with this. This is something that has happened since yesterday. The sellers have stayed in control. Now going back to our slides, price would have, back to the example we were looking through, a TPO count below the point of control, but price not going anywhere. Had the sellers been aggressive, price would have shifted lower. That's what we're seeing today. Price would have shifted lower and would eventually have moved the point of control, and therefore the perception of value. The TPO count would have shifted due to the change of point of control and possibly shown a favour of shift in the direction of the sellers. So it's a way in which we can measure who is currently in control of the market. And a day like today, we can see this, because what we will get at some point is we might get a shift in this TPO count. If price and time still stays below here, but let's say for example it shifts and trades up to 89 on the next print, which is only in 5 minutes time, then this TPO count will shift lower because we're going to get an extra letter here. Okay, so in 3 minutes time we're going to move out of the P prints into the Q prints, and so we're going to start building that next layer of letters. And as those next layer of letters build, we're going to shift our point of control even lower. That looks as if it will happen. And so the TPO count is also going to shift. And it's going to shift from what is roughly 69 to 52. It's going to shift by roughly, what, I'd say another 15 TPOs. So it will show a TPO shift in terms of, it will shift to probably about 85 to 35. Does that make sense? You look a bit...
Yeah, when you say 85 to 35, I mean, 35 is quite a way down.
Yes. So if say for argument's sake, I mean we might get lucky enough to wait here and watch it. If for argument's sake the TPO shifts to here, the point of control rather shifts to here, we're going to get an extra amount of TPOs in this amount, which is then going to be added to the TPOs that are above the point of control, and we're going to lose them from the TPOs that are below the point of control. So it's going to show a further shift in imbalance.
Hopefully we do see that.
Alright, well let's, I mean we can wait it out and see if we're not sure. This is where I need like a pen or something that I can just write on my monitor and add it all up.
Below is 53, so when it actually shifts, that chart becomes 100.
Okay.
Yes.
Yeah, alright, it replaces it. Yeah.
Take a seat. Yeah, that's what will happen. As the point of control shifts lower, the TPO count will shift, because the ones that are now below will become above. So you will add them to the above and you will lose them from below. So the TPO count will show an even further imbalance. But what we know at the moment is that price is still shifting lower. So we do know that this imbalance is to a large degree being accepted by the market, because price is moving lower. If price weren't moving lower, then that would alert us to a potential change in the environment. So we've now got our new letter. So I don't know whether we're going to see the market move up and trade 88, but were the market to trade 88, we would see a shift in the point of control. We would also see a shift in terms of the TPO count. So the imbalance is growing. And so long as price is moving lower, then that imbalance is being accepted. We're accepting that we're in imbalance, but we're still looking for where balance should be. If we start shifting above our point of control, then it alerts us to the fact that maybe the sellers aren't as aggressive as they used to be, because price is not moving. So it's all about, this isn't a way of making this isn't if this, you see this, you should then trade like this. It's a way of monitoring who's more aggressive in the market, who's pushing this market, and how can I align myself with who is more aggressive. That's what you want to be looking for. So we'll go back to that, and we'll have a look at that as we carry on, and hopefully we'll see where that has been shifting. Not a lot of time is given to TPO counts in the book, funny enough. It only gives a very, very small amount of discussion to it, but actually I think TPO counts are probably more important and warrant a lot more attention than the book gives them. I think it's a very, very good way of assessing, the dynamics and the control, and giving you that extra layer of information in terms of when the market is maybe just running out of a little bit of steam. We're all looking for highs and lows. That's what we're looking to do. We're looking to sell the high and buy the low. That's what everybody wants to do. And this just gives us a little bit of information as to when maybe that, some steam is just coming out of the market. Maybe that aggression is, getting too much. It's very unlikely that you're ever going to see a point of control on a high or on a low. It does happen, but it really shouldn't happen. So of course, if we can monitor the shifting of that point of control and monitor the aggression with which traders are trading and the reaction to price, the more aggressive traders are with price not moving, should alert you to the fact that the price, if they step off the gas, the price should pop up. And that's what we're looking for now. As the market's coming towards a low, we're all sat here thinking, I wonder if this is the low of the day. I wonder if this is somewhere that I should buy. Well, of course, if we start to see price not shifting with a very, very aggressive TPO count, which we're going to have a very aggressive TPO count if we trade to here. The point of control is going to be very, very low, and it's going to be a very aggressive TPO count and an aggressive imbalance. So of course, if price is not shifting, it's only going to take them to step off the gas a bit, and we'll see price pop higher. As we go through the book, we talk a lot about initiative versus responsive buyers and sellers. Initiative is when a market participant, a trader, is acting on their own. And what that means is that they're looking at price and they're acting and trading according to what they think is going to happen. So they are initiative. They're not responsive, which is responding to the opportunity of price. So an initiative trader is one who is either looking to create the move or is getting on a move, and a responsive trader is one who is saying, this price requires me to respond. It's quite a subtle difference, and unfortunately the two do cross into each other, but both do tell a slightly different story as to what is happening within the market. So you get four types of activity. You get initiative buying, which is obviously someone who is saying the price is here, but I'm buying. Okay, so often you'll see that break on a breakout, breaking through a level, breaking news, just reacting. So everyone who was selling that cable yesterday was an initiative seller because they were getting on the move as it went. Responsive buying is what would have happened yesterday when a trader saw the price was too low and thought, I've got to get some of this is ridiculous. Or a responsive seller is when prices got too high and they step into the market. So they're absent from the market until price gets to a certain point, and then they become responsive to that price. Of course, an initiative buyer will meet a responsive seller, and an initiative seller will meet a responsive buyer. So the two merge and the two cross. So initiative buying is any activity that is buying occurring within or above the prior day's value area. So it's someone who is stepping into the market, as we've said, on some form of breakout. In this case, we're defining it very specifically as any activity that is buying occurring within or above the prior day's value area. Initiative selling is any activity that is selling occurring within or below the previous day's value area. So, going back to our example, there would have been no initiative buying up here because we were buying within the value area. Now that the market is coming off, we're not going to get initiative buying. We're going to get responsive buying because the price is lower than yesterday's value area. So carrying on through our example, responsive buying are buyers responding to lower prices, below value. They're stepping in and saying price has moved too low. I believe this to be below value, and so I'm responsively buying. Responsive selling is responding to higher prices, so prices above the previous day's value, and stepping in to sell the market. So let's go back to the story that we've seen today. We are never ever going to have had any responsive selling. Agree? Yes? No? Yeah? We're never going to have it because responsive selling is only selling above the previous day's value area. So we're never going to have seen responsive selling today. We're only going to have seen responsive buying. Likewise, we're not going to have seen initiative buying because we haven't gone above yesterday's value area. We're only seeing responsive buying. We're not going to have seen responsive selling, but we have seen initiative selling. So what's stronger? Well, today we can see quite clearly the initiative selling is stronger than the responsive buying. Why do we know this? We know this for two reasons. One, price has shifted lower. And two, we go back to that TPO imbalance and we can see that for the most part of today we have had an imbalance to more TPOs above the point of control than TPOs below the point of control. So the story that we're telling ourselves now is, which way do I want to be aligned? Who do I want to go with? Do I want to be a responsive buyer? Pretty unlikely, isn't it? Do I want to be a responsive buyer when price is shifting lower and I know that the initiative sellers are stronger? Well, no, I don't. So I want to align myself. Although I might not want to personally be selling a market, I might want to wait for the bounces to higher levels so I can sell. But I would much rather, over the course of today, be, for now, a seller. Okay, I want to align myself with this because we're below yesterday's value and the initiative sellers are winning. If the responsive buyers were winning, it would be very, very different. It would be a very different story. But they're not, because price is shifting lower. So regardless of the fundamentals that are behind this, regardless of the backdrop behind this, it's very clear how you can start building a picture quite quickly just based on a couple of bits of information. Now, as this progresses, we've got our Qs that have run up to 86. So we haven't quite shifted our point of control yet. But what is happening to our TPOs? Well, the TPOs at the minute, we've got 69 above and we've got 63 below. So we are attempting, we haven't done it yet, but we are attempting to find that low. We are attempting to find that balance. I don't want to jump into this yet, because still the strength lies with the initiative sellers. But I'm alert to the fact that there's a little bit of balance creeping in. That balance will only strengthen to the seller's side if we shift our point of control, which we've discussed, but we haven't done that yet. So our point of control is still up here. So we're still saying that fair value is up here at 96. That's what we're saying. We're still assessing. Our fair value is still up here, and at the moment this is a market that is doing its utmost to try and find a little bit of balance. So it does indicate that today, for now, we might just be running out of steam a little bit. Just maybe. So we'll keep coming back to that and having a look at that. So, as we've discussed, a responsive buying tail is also an initiative selling tail. So we have discussed that one merges into the other. An initiative selling range extension and the responsive tail to the lower prices are one and the same thing. Buyers will always meet sellers. So we need to always address, and we always need to try and understand the interaction between them. But what always comes first is initiative. Initiative has to come first. Initiative pushes to new areas. Responsive responds to the new areas that we've come to, because response is based in its decision on the price. Initiative is just into the market, causing the move. So an initiative buying extension above value, so as we've discussed, you only get initiative buying if you're buying above value, can also be met by a responsive selling tail, as sellers react to the higher prices. The tail becomes valid when it's confirmed by a rejection of price in at least one additional time frame period. Now, this is where you hear me talk about wait for the close. So many traders don't. They feel that they're going to miss the bandwagon and they're going to miss that top, or they're going to miss that exact low because they're not waiting for the close. A tail is only valid when it's confirmed by one additional time period. Does anyone know why that is the case? The reason is because if it's not confirmed by an additional time period, it will turn into, and we will find one and we'll stick with our bund, it will turn into this. It will turn into single prints. So if you are trading and you are saying, let's say for example, this market's breaking lower, this is a half hour letter. Now for all we know, the market could have paused at the price of 12. It could have a little move back up in the Fs. It could have done. We don't actually know. It could have moved up to 22. And you can get people saying, tails in, tails in. But of course, so long as before the capital F becomes the capital G, so as long as before you get that time period shift, this market makes a further move, you're never going to see it. This could have happened, this move down to 12 could have happened at, I don't know, it was late, so it could have happened at maybe 6:05. It could have moved to 11s, it could have bounced back up to 18s, it could have come back down to 13s, it could have come back up to 25s, and then 5 minutes before the figure closes out, it could have collapsed and then closed out down here. Now on this occasion I suspect it didn't. However, you have to wait for the close to confirm whether you have a buying tail or a selling tail. So you have to wait for that, because otherwise it can turn into single prints, because you're only getting, each letter is a half-hour snapshot of the market. So of course what happens in between is a great unknown. Of course we've got 5-minute charts, we've got footprints, we've got all the other wonderful things that I'm going to, over the course of next week, be showing you. But this is a half-hour snapshot. So until you get the close, until this market says that the tail's in, and we get a close, you know, at a decent area, and that tail is in, then it's not a tail. So you have to wait for the market to give you that one additional time frame. Otherwise, it's not yet confirmed. It can turn into a set of single prints. Sorry, hang on a second. Hi Bobs, what's up? I'm busy. Can I call you in like 15 minutes? Right. People do misunderstand the concept of actually having a job sometimes, especially women. No offence. So to sum up, initiative buying and responsive selling occur above the previous day's value area. Responsive buying and initiative selling both occur below the previous day's value area. It is always our job to understand where the market is, who is initiative, who is responsive. Initiative is always going to be most aggressive until it finds that responsive. So, trending versus bracketing markets. This is something as well that I want to explain now and take the time to explain, because we do come back to this. A trend is a divergence away from value. It is the series of day auctions moving in a clear direction over a period of time. As per what we have seen in our 10-year chart, fantastic example of a trend, because the market is moving away from value. In a series of 5 auctions, the market is moving in a clear direction. Price is being accepted at every lower point of direction. A bracketed market, a range-bound market, is a market with a series of price movements contained within that range. So a trending market ends when price begins to auction back and forth between 2 clear reference points. A trending market will always finish in a bracketed market. You will never ever get a trending market shifting to a new trending market. It will not trend down, then end, then on a dime trend back up. It does not happen. It's an absolute, I don't know if anyone says it happens or if anyone preaches that it happens. It doesn't. A trending market will always end as it shifts into a bracketed market. It will decide that it has found balance and it will sit within the balance. A new trend will then form and begin when you leave that bracketed area. That of course can still be either way. We can decide that we are going to continue a new downtrend, or of course we can decide we're going to enter a new uptrend. But either way, we will always have that middle point on any time frame where the market is bracketed. So even down to a very, very short time frame, the market could come off over a figure, maybe for 5 minutes or so, and then it could spend 20 minutes bracketed. What you'll often find develop is what, when we move into other areas of charting, this will often visually represent itself slightly differently on a candlestick chart and could look like a flag or a wedge or some sort of new area where you can define that that secondary break is going to enter a new trend. But whichever time frame you look at, 5 minute up to a monthly, yearly chart, trend will always be followed by bracket and then new trend. Markets actually only trend 20% of the time. 20% of the time. And so if you're an algorithm or you're a trend following algorithm, you actually, and this is very, very true, having risk managed a lot of algorithms, the drawdown that you have to suffer will be where the algorithm is attempting to find the new trend before it's ready to trend. And so it will get caught in a bracketed market and it will lose money as per design. And then of course when we enter the new trend, then it will make all its money back. So that's traditionally where you do get, the algorithm makes money, draw down, and then it makes further money. Because an algorithm following a trending market will actually only make money 20% of the time. Funny enough, an awful lot of traders probably also only make money 20% of the time. They probably make a lot of their big days, big money, like 90% of their money in 20% of the time because they get on the trend. Now, it's the 80-20 rule. But of course, the key for us is knowing when that market is trending or bracketing. Because even if we don't want to make money in a bracketing market, what we don't want to do is lose money in a bracketing market. So you get a lot of people who are quite content treading water in a bracketing market, and then they will make a lot of money when the trend turns up. Conversely, actually, there are a lot of traders that are excellent at bracketing markets and make a lot of money 80% of the time, but then they will really do their arse when it enters a trend. It's very hard, and I haven't seen many traders who have got the ability to adapt between a trending market and a bracketing market and actually make money in both. The traders that can are the superstars. They really are the superstars. The other guys, they might be great traders, but they'll have a big time, a big run of time, and then they'll stop a bit, and then they'll have a big time, and that'll be the trend, the bracket, the trend. And then you'll get the other traders who do really well, very, very consistent traders, do really, really well, but as the market enters the trend, they lose money, and they have that drawdown. And that tends to be you get traders that are very good at trending markets, traders that are very good at bracketing markets, and not necessarily good at both. Unfortunately, what you get is you also get markets that have a fake move around key bracket points. What they are trying to do is get the trend following systems shifted in to the market, get them to enter the trend before they come back into the bracketing market. So you've got to be aware of all types of different games that are played in and around your key bracket points. The key to trading trending markets lie in the value areas. A series of value areas moving in a clear direction is an indication of a trend. If the value areas begin to overlap, then the chances are that the trend is slowing. A trend is started usually by initiative action. Both an uptrend and a downtrend will end in a bracketed market. In a bracket, both buyers and sellers become responsive to prices and the market is in balance. The point at which price begins to be accepted either side of this newly developed bracket is when a new trend is likely to be on the horizon. So we must always be observant to value. Now, what a great example we've got at the minute. Because if we go to our 10-year, this is a market that has been on a major 4 or 5 day trend. Major 4 or 5 day trend. So look at our value areas. Both volume and TPO. We start up here. TPO and value area lows here. No overlapping. Okay, we've missed them both. TPO and volume value area, we've missed. Day one, we should be alert to a trend coming. Okay, day one, we should be thinking, okay, here's a trend. Day two, look at the big divergence. TPO low, volume value area low, TPO high, value area high. A really big shift. We got alerted to it on day one. Day two, we got it. We should have been thinking, how do I get into this? How do I get into this trade? The two clear areas are, of course, at VPOC or at our TPO point of control. And absolutely categorically our stop has to be above here. Has to be above the previous day's value area high, the previous day's TPO high. And you could have been on that trade here. The market massively shifted lower. No overlapping. Third day, still no overlapping. Still no overlapping. Even if we screwed up the first day, we could have got onto this the second day because we knew the trend was strong. We knew the trend was going to be strong here. And so we didn't even get up to VPOC and we shifted lower. Value came in a lot lower again at no overlapping whatsoever. TPO was up here, no overlap. Volume here, no overlap. Yesterday, a bit of overlapping. So the trend is slowing. The steam is starting to come out of this trend. We get that little bit of overlap. Now, of course, we're not making a decision that we're going to jump in and buy today because we're only saying the trend is slowing. We're not saying the trend is finished because we could get another day where we don't overlap and then the trend is carrying on. But we're always alerted to the fact, what type of market are we in? Is this a bracketed market where we have one trading strategy, or is this a trending market where we have a completely different trading strategy? And the key is knowing which market you are in. And as soon as we do that, I promise you 90% of your job is done. Knowing what market environment you are in is 90% of your work. And it's very, very clear. So the Bund, what's the Bund doing? The Bund has been a bit harder. Okay, so we've had day one, we've had our TPO up here and our value areas outlined here. We got no overlapping. So we shifted lower, so we should have been alerted coming into here. Okay, possibility of a trend here. All of a sudden, on this day, you're thinking to yourself, well, I'm more likely, there is a better risk reward of aligning myself with sellers than buyers. But actually it was really awkward because the thing balanced. And it balanced until we got news, and we know that news actually then shifted us lower. But then the next day, again, we had a bit of overlapping on the TPO, but we didn't get any overlapping on value. So we're in a bit of a trend, but this is a market that's not as strong a trend as the 10-year. If you're taking a direct comparable, this is a market that's finding it not quite as easy as the 10-year to come off. So the trend is there, but if you had to have a conviction scale as to which trend was stronger, 10 years kicking ass all day, every day. But we do know that the trend is there. We do know that it's struggling a bit. And of course yesterday was again a bit of a struggle because we had overlapping value. So we're alert to the fact that the trend is there, but it's maybe just a touch weaker. And so again, when we come into a day like today, we can use that reference point. We can say to ourselves, well, we know the trend is there. We know there's a TPO imbalance where the market is thinking the initiative sellers are winning. But we also know that that trend's not maybe quite as strong as we think. So we're looking, we're alert. Is there a low soon? Is there a point at which I should maybe just ease off the gas of selling? And maybe should I be thinking in terms of this trend is just slowing down a touch? So of course, if we go back to our TPO counts, what we've got now is we did have that shift. Do you remember the TPO was a little bit higher? And then we shifted it because we've had a couple of new prints now. So we've had a couple of timescales while we've been talking where this market, the TPO count and the point of control has shifted. I think we were up here before, 92, 93. We've shifted it lower a couple of times. We probably shifted it to 88 and then shifted it back up to 90. And our TPO imbalance has changed. So it's now 94 above to 46 below. So we're bringing all this information together. We're saying that we're in a trending market, but it's been a bit more of a struggle. We've had a lot of overlapping, been suffering this trend. It's not the 10 years trend. It's been struggling a bit. Just looking at today and the information that we've learnt, this is before we start talking about opens, the information that we've learnt is that we have got a day where we've got a lot of initiative sellers because we're below value. We have a lot of responsive buyers. That's all we've had really today, initiative selling and responsive buying. The TPO is quite imbalanced. We've got 94 TPO prints of sellers, 46 TPO prints of buyers. But the key variable here is price. Price has stopped moving lower. As we now sit and as we speak in real time, we have seen that the TPO print and the point of control has shifted, but price has moved higher. So price on this occasion, right here, right now, has not responded to the initiative selling. The responsive buying is beginning to outweigh the initiative selling. There are still a lot more shorts in this market than there are longs, but the longs are starting to take control. We also have a buying tail. So no longer Do we want to think in terms of being a seller? Actually want to start shifting our bias. We want to start shifting our bias and saying, do you know what, actually the information here, the information that's available to me is telling me that we could have found a loan. And that maybe, just maybe, the buyers are getting a bit of a foothold. They've tried before because we've had overlapping value areas. So this is a market that is not so aggressively selling that, like the 10-year, I'm just going to keep going with the sell side, I'm going to keep being short. This is a market where the trend has been slower, where the trend has not been quite so prevalent. And so we're aware that this is a market that could find a loan. Our TPOs are indicating that all day the sellers have been in control. All day you've wanted to be with the sellers, but they've stopped being able to shift price. They've stopped being able to move price any lower. And we have a buying tail. So now we're going to look for the buyers to exert some control. And we're going to shift our allegiance right here, right now at 10:30. We're going to shift our allegiance from going with the sellers who have been moving price lower to maybe going with the buyers, or at least not be such an aggressive seller, because all of a sudden the buyers have stopped the sellers being able to move price lower. And there is still an imbalance, and that imbalance will stay unless the point of control shifts up again. And if the point of control starts shifting up again, and we get TPOs above at say 120 and TPOs below at around about 120, what has this market found? Balance. Value. Exactly. That is exactly what this market has found. And we can assess this constantly. We can assess. I mean, blimey, we only had, this is going to scare you, we've only had 6 of the 7 slides here. The next slides, I'm starting to think we're not going to get through it. The next set of slides has got 41. So we've only gone through 6 slides, but already we can see how how we can maybe start to understand how markets find balance, how they shift from a trending market to a bracketed market, how the TPO counts give us a sense of who is in control, understanding who's initiative, who's responsive, understanding the importance of those value areas, can all give us, and it is only 6 slides, but this is why I wanted to spend all day on it, because it's so important. So 2 famous questions. If you want to be a smart ass on Twitter, you quote these questions, but I promise you they're from page, this is why I don't pretend to be a smart ass, they're from page 57 of Mind Over Markets, and the 2 famous questions are: which way is the market trying to go? And is it doing a good job in its attempt to go that way? If you see someone on Twitter quote that, they haven't made it up, they're not bloody geniuses. They've either been on one of my courses or they just happen to have read Mind Over Markets. Which way is the market trying to go? The Bund today, market was trying to go lower. Is it doing a good job in its attempt to go that way? Actually, no, it wasn't. Price stopped shifting lower. Point of control shifted lower, but then shifted higher again. It wasn't doing a good job. And so those 2 questions, if you can answer those, which way is the market trying to go? The 10-year. Let's go back to the 10-year. Which way is the market trying to go? Lower. Is it doing a good job? Yes. At the minute it is, because it is facilitating trade lower and people are willing to expect it. The moment this market stops being able to facilitate trade lower, it's not doing a good job. And we can alert ourselves to the fact that we might be coming out of a trending market into a bracketing market. So, that is our first set. We're going to come to opens. I think it's a great point to take a very, very small break. We haven't got much time to take a big break, but I do need the gents, and I'll find out what my missus wanted, and I'll make a coffee. So if we can all be back here for like in 5-10 minutes, and crack on with opens. I want to get through this. We've got a lot to get through. Okay, let's take 5. I'm going to leave things just run, guys, on the VTFT. Just let it run. Saves me logging in and out.
The energy markets. Just a quick note that a speech to the G24 meeting that's ongoing today from the OPEC Secretary General Barkindo has been posted to the OPEC website. So a full speech text from Barkindo is on the OPEC website against the speech given to the G24 meeting taking place today. And much of the speech just recapping what's happened with OPEC, particularly the Algiers meeting. But he concludes by saying that the deal in Algiers will help to return stability to the global oil market and lessen volatility. And it's important to underline that things have progressed further over the last week. Barkindo saying that consultations remain ongoing amongst OPEC. And the high-level committee initiated by the OPEC conference is moving forwards on the implementation of the Algiers decisions, with the steps are being taken to further develop a framework for high-level consultations between OPEC and non-OPEC. That they believe there is firm and common ground for continuous collaborative efforts among producers both within and outside of OPEC. So again, Barkindo basically saying things have moved forwards even since the Algiers meeting last week, that dialogues have been ongoing and they're building a framework for consultations between OPEC and non-OPEC.
See you later. Bye. Ricey ho. By the way, I'm not expecting you to remember all of this. Half the time, I bloody can't.
Well, it's just getting familiar with it. At least we've got the weekend to go over it.
Yeah, I think some of the, when I think about traders as well, some of the best traders I know are the ones who have got the best process for remembering all of this, because it's so hard. Some of that, like the TPOs, it can become intrinsic, but sometimes you can get so wrapped up in your trading day that you even forget to look at the TPOs, because it does take up quite a lot of space. So, you don't want that all day, every day in front of your screen. So sometimes it is quite hard to remember the TPOs, but yeah, I think some of the best traders I know are kind of the best note keepers and the best record keepers, because they've just got their process and they've just got it in front of them all the time, so that they know, and they develop a process so that they don't rely on like human memory. So I mean, I'll leave that with you, how to develop that sort of process. But you can see the market has shifted up, so we assessed that correctly at least. So the market has moved higher. Alright, now this is going to be quite a lot. It's also going to be quite difficult, because the hard thing about talking about opens is finding retrospective examples. So that's actually going to be quite tricky, I think, because you sort of see them in real time, but they're actually quite difficult to find and assess. But I go on about the opens a lot, like seriously a lot. You might, if you are sort of starting to listen to some of the live streams, the live analysis, I bang on about the open all the time. And it drives me insane when people don't remember it or forget it, because not only is it the first piece of information you get in the trading day, it's the first sign of bigger market participants' sentiment. And it's also there are so many different ways that you can assess the open to actually give you an example and an indication of the whole of the rest of the day. That to not pay attention to it or not understand its relevance or the significance of that initial balance is just criminal. I mean, I honestly don't think you can make a living trading, as a technical trader, for sure, I don't think you can make a living unless you really, really understand the importance of the open. So there are 4 types of open. Within one of those, there are a couple of other ones. So in essence, you kind of get 5 types of open. But there are 4 types of open really that you need to be 100% aware of. There's the open drive, the open test drive, the open rejection reverse, and the open auction. They are your 4 types of open that you need to understand and be aware of. The open drive is by far the strongest of the opens and is fueled from the very beginning, from the opening bell. The market opens at its low or its high. It drives in one direction, and the price never returns to trade at the opening price again in the initial balance. Recent statistics have actually proven that 75% of the time open drives are prone to failure. However, pure market theory dictates that the open drive should hold all day resulting in a trend day.
No fresh catalyst beyond.
Now, when we get to some sort of candlestick analysis, this type of day has got abbreviated to be called a Larry day, in terms of, you know, a guy who spoke about it quite predominantly. But for now, this is what an open drive is. It's where the market opens at its high or its low, and it drives for the rest of the day. Now, we have fortunately had a couple of examples of this recently in our Bund. And I know that a lot of people lost money on this day because of that statistic. So, this is an example of an open drive. So the market opened on its low on the K prints. It drove higher, and we never ever came back to trade that opening price. There was a very, very clear intent from the open which way this market wanted to go and which way this market was going to drive. On a day where you see this, the first thing you should be thinking is that we are very likely to get a trend day. That is the highest likelihood, the highest likely outcome of an open drive. Okay, so it's an intent from the opening bell that the market is going to move in this direction. Now, what I would say is that actually statistically we're in a position where it's widely known and widely believed that this doesn't work or hold a lot of the time. Funny enough, who'd have thought that the statistic on this was, give or take, the 80-20 principle. So, roughly, when you see this, it will end up in an open drive 20% of the time, because it matches perfectly the statistic that markets trend only 20% of the time. It's not clever to sit there and get a stat going, oh, it happens to be 76% or 0.2 of the time. We know this going into the bloody market. We know this is the case because markets only trend 20% of the time. So it's not big, it's not clever, it's not logical. But we do know that it happens to work, and this is, you know, pure theory dictates that when you feel this is in line and this is going to work, that it is going to work and that you are likely to have a trend day. So of course, here's another day where people thought it wasn't going to work because we opened here at the low of our day and we initially drove higher quite aggressively. So again, people came out and they said, oh, I'm going to start picking tops, I'm going to start going for a sell side here because this never works. Well, of course it does, 20% of the time. So as long as you understand those basic principles, 80-20, 80-20, I don't care if some genius says it's 76.8, you know, whatever. 80% of the time, the market's bracket, therefore 80% of the time this might not work. However, it's the strongest indication that a trend day is coming, and you get this indication by 7 a.m. So you must never ever forget it. Now I can find an example of when it didn't work, because this got quoted by a lot of people again on the wonderful world of Twitter. It got quoted as not working, and people, this is what got pulled out of the bag for not working. So up here, I wonder if, where can I split it here at the L's. At this point you can see we've got an open driving place. So at this point the market has opened at its high and it has aggressively trended lower, but of course it did find support it found support on the L prints. So if we just make another split here, you can see it eventually found support on the L prints, and then we started to move higher. So of course the M prints got us back into initial balance. The N prints got us very close, so let's do another split. So at this point the open drive is there, it's still holding. We've made a low at the L prints. We've had an M and an N print that has got us close, but it wasn't actually until the O print, no, the P print, where we actually broke through it and it failed. So the O's looked pretty quiet. The O's were very, very quiet. And then on the P's, we popped higher, and we actually broke that open on the P prints across here. So it did fail on that day. It did undoubtedly fail. You can't deny it did fail. But there were certainly trades to be had. There were certainly trades to be done. I guess the first sign that this was going to fail was, of course, that we were starting to balance within that range. Maybe you could have had a look at your TPO counts. Maybe you could have had a look at, you know, a few other things to indicate and give you a secondary clue that we were going to fail. But it did, you know, it was an open drive. It did fail. That does happen an awful lot. But, you know, there are trades to be done, trades to be had. But of course, in pure theory, in pure technical terms, you should always align yourself with the profile. You should always go into the profile, understanding that an open drive in pure theory should hold all day. The next type of open to pay attention to is the open test drive. And open test drives are initiative in nature, but they don't happen right on the opening bell as with an open drive. So it's not right off that K print. By definition, an open test drive occurs when a market opens and then tests beyond a known reference point to see if there is any new business. The market then reverses and quickly auctions back through the open and continues to drive in the opposite opposite its initial move, exhibiting strong initiative activity. Often the extreme price established at the reversal soon after the open holds for the entire day. It's highly reliable in nature, and we look for a normal variation or a trend day to develop. Now, we are so lucky, because guess what example we can use for an open test drive? I don't even have to go looking for this. Today. We had an open test drive today. So what we had was, and it's so lucky to be able to get one today. What we had today was an open, and the market had an open test drive. It tested to see what was up here. Is there any new business? Is there anything up here that I'm scared of? Is there anything that I need to be worried about? And the market said, no, there isn't. No, you're fine. And so we reversed. We came back through the open, and we continued to drive in that direction. Now, what day does it look like we are going to develop, or what day have we developed since then? A trend day or a normal variation? I'd say it's more of a normal variation day. Okay, so our normal, let's pull up some of our old slides. When did we start market profile? Was it last week? day types. Yes, it was. Neutral day, non-trend day. Where's our normal variation? There you go. It's the most common of different day auction. On this day we see a range extension outside the initial balance, and often the market continues to probe on the same side as the break and goes to complete it by extending. On a normal variation day, the first 30 minutes are often spent above or below the previous day's value area, and price seems to suggest a rejection of that value. We see value built higher or lower. So we're not breaking and breaking and breaking, and we're not, like a trend day we would have. I don't think there's many good examples on here. I'll find. So we know what a trend day would look like. Normal variation of a normal day. So we know what a trend day would look like, because it would be that elongated profile with single prints and all of that mess in between. But of course a normal variation day is more, I'll show it to the camera in a minute, is more like this, where we sort of got value just built like a B print. So that B print profile. So if you're tagging along at home, page 22, that's your normal variation day, where you've got that B print looking profile. That's more what you're looking for, and of course that is more the shape that we've got developed down there. So we've turned our open test drive that we've had today, we've turned it into a normal variation day. Not a pure normal day. We said a normal day is particularly rare. A normal day was what was it? Eventually price. There is little strong directional conviction, and price balances between the early extremes. So more where you've got that very, very big initial balance, and we sit within that initial balance. So had this day we had this big move, and then we sort of contained ourselves in that big early initial balance, that would have been a normal day. This is a variation of a normal day, but whereby we've had that open test drive. And of course, conveniently, this is giving us all the examples of market profile, because the price has now moved higher, and our assessment earlier that we were nearing a low, which we did at 10:30 in real time, has come to fruition, because we're now sort of 10 prices higher with all of the information that we've given ourselves. But today we have had that open test drive where the market has looked higher, decided there was nothing, and then it's driven lower in the opposite direction. Other days where we may have seen that happening, see if we can find any. Actually, I'll tell you where we have been having some. We've been having some in the Eurostoxx. There was one the other day in the Eurostoxx. This was a really good one, actually.
We've already seen sources yesterday.
So this is almost like a combination of the two.
These talks were just to discuss implementation and not necessarily to reach a final deal, and a final deal not expected until the OPEC meeting in November.
Okay, so this is almost like a combination of the two, because we've almost got an open test drive in our theory. So we're actually thinking, okay, alright, okay, an open test drive, but in the back of our mind we're thinking, yeah, we kind of know this doesn't work too often. So there's a 20% chance that this is going to be a trend day. So quite a low chance. But then what happened is, if you look, this is an old high of the day at 30. So what has then happened is the market has said, oh, let's go have a look above here. Let's have a test above here. Is there anything scary? Are there any stops? Had stops have come out here and knew what type of buying? New initiative buying had come in, we'd have turned into a trend day. Okay, because we were above yesterday's value, so this was always going to be initiative buying. Had that new initiative buying carried on, we would have turned into a trend day. But what actually happened is we had a test above here, and the responsive sellers weren't going to let the initiative buying overpower it, or the initiative buying just wasn't there. So we had a test above a very significant area on an open drive that failed. And so of course, as we came back here, we start to realise that actually what we've seen is not necessarily an open drive. It's a little bit more of an open test drive. It's certainly now alerted us to the fact that there's been an open drive that is going to fail. And we've come above a very significant reference point, and this market has failed it. There's only one way this market can go from here. There's only one thing that can possibly happen, and the market takes out this low and it starts exploring lower. And this happens a lot. This market did it here. This was an open test drive on here, so let's split this on the L's. So the market's opened here. It's had a test into yesterday's value. Is there anything in there? Is there anything here? Is there any initiative buying in here? No. There's no buying. Therefore, below yesterday's value, initiative selling overpowers any form of responsive buying or any form of buying that might be in. A little test through value and then lower. And again, this is a very early doors indication as to the opening type that we've got. Now we need to put in line, we need to obviously, as we keep unraveling our profiles and unraveling our theory of market profiles, we need to put this into context and start assessing our ranges of the initial balance, because that gives us a further indication as to day type. But that very, very early initial kick that the market gives us tells us what is likely to happen. What type of day straight from the open am I looking for? If we get that open test drive, I am looking for either a trend day or I'm initially looking for a normal variation. So right at the beginning, right at the very outset of our day, we know that when we come in, there are only 6 day types. Well, of course, if our open can start draining or taking away some of those options and leave us with 2 day types to contend with, well then the way in which we trade can be adapted very, very quickly. Your next type of open, I know we've still got more on the open test drive. The odds favour placing trades in the direction of the driving activity as close as possible to the tested extreme. Once the drive has began, the price should not return to the point where the drive began. Very often I would say that this is usually at the open price. So you normally find, and we've got one today across here, if you see, we've had that test. This is the Euro stocks. We've had that test above VPOC. There was no new business. We then drove lower and we've continued. You know, we've not got a trend day, we've got a variation of a normal day where we're balancing to the underside of our initial balance, but usually price would not creep too far above your open because that's where the drive begins from. In both the open drive and the open test drive, the initial extreme is established by the early entry of aggressive buyers or sellers. The open drive is obviously right up like a racehorse out of the gates, I think was one of the examples, and the open test drive just requires that little bit of confidence as to what's there. So of course the conviction rate has dropped slightly more. So the conviction rate on an open drive is very high. That's why if the trend day does develop, you know, the conviction rate is high. On an open test drive, traders are a little bit more nervous. They want to see what's above first before they commit. You know, traders are human beings. You know, very few will just, you know, like when you go to the creepy crawly house or whatever, it says stick your hand in the black hole and see what's in there. Very few people will do that. You know, an open drive is like that. They'll just go right bang, yeah, I don't care. An open test drive is, well, what could be? Have a little peek, have a look at what's under there. That's what most people want to do. Have a little look, see what's there, and then they can react accordingly. Oh, it doesn't look too bad, it's a fluffy pillow, you know, and goes your hand. The openings, these openings of course are the less common types of opening. The reason of course they're less common is because they indicate more of a trend, and we know that the market is not a big trending dynamic, so it's a much lesser type of common type of opening. Open drives, as we've just discussed, a lot of people talk about the markets need to break first to rally or rally to break. This means that the market needs to test those lower prices first before they rally. If the test lower lacks volume and initiative activity, buyers in this case can try the higher prices with the conviction because the lower prices didn't draw in more participants. Again, back to that conviction rate. A rally to break means that the market needs to test those higher prices first before selling off. If the test higher lacks the volume and the initiative activity, sellers can try the lower prices with conviction because the higher prices didn't draw in more participants. Of course, had either of these things actually had initiative activity, you'd have seen them break higher or you'd have seen them break lower, and your day type instantly changes. You're looking more at a trend day developing, of course. This testing behaviour provides traders with the assurance of knowing there is no activity. I'm going to have to change the spell check. Provides traders with the assurance of knowing there is no activity above or below, depending on the initial direction of the probe, before moving the market in the other direction with confidence. So it's all about understanding. This is where of course people do get trapped, because they see a market test into an area, test an upside to an area, you know, and then it fails. So of course a lot of people make the mistake, and we come back to this a bit later, where they don't understand that test, although it's stopping some traders out, or maybe it's stopping a set amount of traders out at the open, it's not necessarily changing the direction. Of course it's giving them the confidence to move it in another direction. So the open rejection reverse. By definition, an open rejection reverse occurs when a market opens, trades in one direction, and then is met with an opposite response strong enough to auction back through the opening range within the first few minutes of trading. The open rejection reverse does not exhibit as strong conviction as other opens, i.e. your open drive and your open test drive, but the reversal often happens quickly. While the initial rejection can turn into something more, don't be fooled into thinking the market has found its direction for the day. The initial extreme holds less than half the time. It's a much less convicted directional profile. So of course we can see reasonably easily how you could confuse an open rejection reverse for an open test drive. With this type of open, the probability of a trend day is very low. So as a trader, you would posture yourselves to fade moves that test your extremes. Patience on these days is obviously key. Now, one of the ways that I tend to assess whether we're having an open test drive or an open rejection reverse is where the initial open is placed and what areas of significance the market is probing through. So you only really can make a full investigation of this once you've established almost more of your initial balance, more of your K prints. So, for example, let's stick with the Euro stocks for now. And let's have a look. Actually, the Euro stocks has been dreadful because we've had these drives on the open. Wow, so many times the Euro stocks has had opens at and near its lows for a long time. Should have stuck with the bund. Oh, there's a big open drive. Okay, sort of a day like this, where you get an open that starts to show itself as being very, very much in the middle of your initial balance, is more where I would tend to think that we are going to have an open rejection reverse as opposed to any form of trend developing. The Euro stocks has been a particularly rank market actually for finding this. Let's see, go back to our bunds. So I suppose pretty much like this up here maybe. This is very much more an open rejection reverse type scenario. We haven't really tested any specific levels. We've come up to the close, and I suppose we have tested the TPO low, and we've come down to this tail. But the situation where this market sits is it's placed its open very, very much in the middle. So when you're likely to have an open test drive, you're very, very much more likely to find your open weighted to one side or the other, because the market's had a very quick look. You know, it's gone in search of an area, and then it's decided that there's nothing above there, and then it moves with conviction to the other side. What you would normally find and normally get is an open that sits very much in the middle and hasn't really tested a significant area or a significant extreme. They, believe it or not, these opens are much more common, but of late, because the markets are shifting around quite a lot, there aren't that many. This is a good example of one. So we've opened pretty much around where we where we established some value areas yesterday, and then we've sort of explored both sides with equal measure across the initial balance. It's very easy to get the two confused, and I knew that sort of coming and retrospectively scrolling back through these, the open drives and the open test drives are much easier to find. It's these open rejection reverses which are quite difficult, because you'd easily be able to confuse them here. So this market has tested a significant area, and it could have looked very much like an open test drive, but actually it's turned into an open rejection reverse because it's just traded through the open. So that you're only ever going to really spot these, unfortunately, as the day develops. because they do look very similar. And certainly in hindsight, pulling them out is very, very difficult. So when we sort of get, some of the examples in this book here, it's sort of open test drive, talks about that open being at the top, and then it sort of tests an area and then it comes back the other side. Of course, at the time, because they're half an hour snapshots, this could very much look like anything from the very, very opening snapshot. So you really are only going to see with any sort of conviction what type of open we have had once you start getting to about 25 past 7, about 7:30. And of course that's why the majority of traders leave the first hour and sit out, because you can only really identify it once you've had those flurries. So this would be an open test drive because we've opened, tested, and we haven't come back through this open today. This could have turned into anything else if we'd have auctioned down here and then on the K prints come back up here. So we just need to be aware as to when these markets make their decisions, when these markets crop up. Generally the first hour of trade is when we're going to get them, but of course an open rejection reverse trades in one direction, is met with an opposite response. We auction back through the open. Of course an open test drive, we open, we test beyond the reference point, and then we reverse quickly. It auctions back through the open and drives in that direction. So we're not seeing, it's not an open rejection reverse, because we are not, it's got more conviction behind it. This market trades in one direction and then it's met with a response that we auction back, but it does not exhibit the strong conviction as these other two. The initial rejection can turn into something more. It can turn into an open test drive, but the initial extreme doesn't hold. So an open test drive, we've got to be aware, can turn into something else. So the open auction, and I think this, if we can get through this is a good place to stop. There are two types of opening auction. Prices auction above and below the opening range. An open auction that occurs within yesterday's value area is different to one that occurs outside of yesterday's value area. In general, a market that auctions within the prior value area and range is likely to be a non-convictional day. A market that opens outside of the prior day's range is somewhat different and then leads to two different types of open auction. So the open auction is that sort of fluffy open, just there, doesn't do a lot, minces around. Unfortunately the most common type, I guess. But then it leads to two different types. If we have an open auction within yesterday's value, we can make an immediate assumption that value has been accepted and we are likely to continue in that vein. Outside of there being any fundamental news, we are likely to remain around that value area. A market that opens outside of the prior day's range is different, and there we get two types. We get an open auction in range. So an open auction in range typically lacks conviction and typically auctions within the previous day's range, testing support and resistance levels. Typically it pays to fade extremes on days like this. When you don't see a lot of convicted buying or selling and we open inside the prior day's range, expect the market to auction. It is searching for a direction. It will most likely auction higher and lower, trying to find new participants. You are likely to find a non-trend day, a normal day, or a neutral day, a balanced day in other words. You wait for the market to establish its extremes and its value area extremes. You buy below value and you sell above value on these days. An open auction outside of range typically has a lot more potential for a dramatic move in either direction, because an open auction outside of range, your market is out of balance. You are outside of the previous day's range. You've had a gap, effectively. The trader needs to be on guard, as it could develop into a bigger move. The day looks like it's got no conviction, but because we're out of range and because we're out of balance, of course, there's a greater chance that we will then find direction. Okay, because we are out of balance, we're out of range, we're away from yesterday. So of course what can happen is you get two types of things. You get acceptance of that new area, or you get rejection. But there is a bigger chance that direction will become apparent than if you'd opened within that range. Because if you're within that range, the market is balanced, and any time the market's out of balance, we know that a market out of balance needs to go and find it, and we don't know where it is. So, to sum up here, the days all merge. One day and the outcome of that day is not forgotten by the market the next day. Markets out of balance have a greater potential, a greater range potential. There are three outcomes based on the previous day's range and today's opening. If we open within the prior day's value area, we're either going to accept it or reject it. If we open in range but out of value, we will either accept it or reject it. And if we open completely out of range, we are going to accept it or reject it. So I think that's probably a reasonable time to take a break and take a pause. We've been through a lot. So we have, just to recap, 4 types of open. The open drive. The opens at the low, we drive in a direction, we stick with it. Statistics give us a little bit of a tinkering, but with those statistics still comes a trade opportunity. The open test drive is the open is still at an extreme. We test an area quite quickly. We reject the area. We test an important area. We reject it, and then we move quickly the other way. On that day, we don't come back to where the drive happened, usually the open, and we're looking for that B or P shaped print or a trend day. So yes, we can still balance, but we are likely to balance at the extreme with which we've driven, or we turn into a trend day. The open rejection reverse unfortunately looks similar to our open test drive, but we have less conviction in it, and we start to see, or we start to look for signs that maybe that open's a little bit near in the middle, maybe that open is sort of not testing as significant areas. And again, with this profile, we're looking for a normal, a neutral, a non-trend day. So again, all of our options of what day type we're in, we can slip down into. So again, if you had a graph, if you were a very sensible trader, you would have a little graph saying, okay, what type of open? You'd know that by 8 o'clock, and then you'd have 2 options as to which day type you were going to move into, and then you would trade accordingly. The open auction is one where we need to split it down even further. Prices auction above and below the IB, we sort of wind ourselves around that initial balance. It occurs possibly within yesterday's value area or outside of yesterday's value area, and then it leads us to two different types of auction. The open auction in range, where if we're in range, we're expecting a trend, a normal, a neutral day. If we open out of range, then we are alert to the fact that we will either accept or reject that price. If we reject that price, then we're going to come back into range. If we accept that price, then it's a different type of day type. So, I think that's where we got to, slide 12. Good time for a break, because again, we're starting to take in a lot. Don't forget, of course, our initial balances. When we went through this the other day, what you mustn't forget is your initial balances. They, of course, give you an idea of the type of day. You know, when we've got this wider initial balance or this shorter initial balance, also puts us on high alert to what type of day. So maybe it's a good idea to sort of recap some of those day types. And you know, again, when we said here, trend day begins with a smaller initial balance. So again, we can start with that very early information, start understanding potentially what type of day we're going to turn into. So we're going to start combining the two. How does that initial balance look? What type of open is it? Alright guys,
That's one quick question, Dan.
yeah, go for it.
You know, you say most traders sit out the first hour
Yes.
to see which way the market's going. Who's actually then driving the market and testing the levels?
It could be algorithms, silly traders. Of course, not everyone's going to adopt this approach. When I say most traders, I mean most good traders. Of course, there's news overnight, so you'll get people trying to maybe jump on the news overnight, so they'll, attempt. What we're looking to do is, assimilate the information and align ourselves with a much higher probability of trade. So, a lot of sensible traders, they might just quickly trade the open, but then they'll sit back and wait for that open to dictate. I particularly never ever like teaching trading the open. I've always said to guys, why are you trading the first 15-20 minutes of the S&P? It's just a shit show, it's a chop fest. But traders still do it. So the traders who think they're maybe a bit cleverer, a bit smarter, they might get an edge. It might work for them sometimes, it might not. Paper, of course, comes in, so hedge funds, investment banks, people who have got to do proper business. I'm not here to kind of teach you guys how to guess. I'm trying to align all of the probabilities in your favour. Make sure you understand how to take high probability trades, low risk, good reward trades. And then, obviously, going forward, if you're a basket case, we've got to deal with the mentorship side of things. But markets move, prices drive, whether it's algorithms, traders, programs, paper. Everybody's always trading. But when I say most traders, what I mean is most successful, good traders would sit out for that initial time. You can make a best summation. If you do get an open there and the market does start going, of course you can guess before you get to 7:30 or 8 o'clock. But for me, you get all of the clues as to what day type you're in at 8 o'clock. So if by 8 o'clock you can work out, okay, you came in and you had 6 types of days that this was going to turn into, and based on A, the size of the initial balance, and B, what open type we had, by 8 o'clock you can probably work your way down to 2 or 3 types of trading day that you've got. That'll do. You've still got 8 hours of the trading day to formulate your strategy. So missing out on the first hour for me has never really been a big issue. Alright guys, well let's take a break. Obviously this afternoon I'll come back on, I'll talk about non-farm payrolls at 1:30. We've still got another 30 odd slides to get to that encompass still a lot of opens, a lot of time frames. It would be really nice as well to watch a bit of non-farms, so it might require a little bit of flicking around, but I think it would be really good for you guys to watch a ladder over non-farms. So it might require a bit of flicking around, but it might be worth it. Let's see how we go. I will see anyone in any event at 1 o'clock to discuss non-farms on the stream. Yeah, let it all sink in and have a good break. Speak to you all in a bit. Thanks guys.